And with that, I'd like to introduce my co-speaker, David Takearts.
Thanks, Kurt. So I'm David Takearts. I'm the Stakeholder Strategy Manager for CalPERS. So essentially what that means is that I help to connect the information that's being generated out of CalPERS, whether it's pension costs, the healthcare side, investments, anything having to do with kind of like the CalPERS equation. My job is to help get that information to the right people at the right time. So sort of a spokesperson in a way, but also working with the CEO, working with the actuaries, working with kind of like our senior leadership team to connect with any interested stakeholder or association of stakeholders. So very often, it would be like the League of Cities. So like a cohort of many hundreds of cities would have top representatives that kind of like speak and advocate on their behalf. So like we're kind of coordinating and meeting with those folks because there are so many employers, there are so many members and retirees, it's difficult to touch everybody directly. And so my work is to try to bridge the gap between the leadership of the stakeholder groups that have a vested interest in how CalPERS performs, the pensions, the costs, the benefits, and what that means for communities and for people.
Thank you, David. So my name is Kelly Fox. I'm a division chief. I've been at CalPERS 2 years, and I run the stakeholder relations division of CalPERS. And part of my responsibilities are to take credit for everything that David does in the stakeholder strategy outreach program. I also supervise a couple other programs, our diversity outreach program, our public records requests, and then our event management. CalPERS, being the big organization that it is, coordinates a lot of events, and our kind of premier event of the year is our educational forum, of which a lot of our employers participate in on an annual basis. So that's what I do there at CalPERS. And again, just 2 years. In my background, I'm a retired firefighter out of Washington State.
Hi, I'm Ian Osugi. I'm the new plan actuary for the City of Yuba City. My primary responsibility is looking over the valuations and verifying the accuracy of the data that we use in the valuations, and then to help set the rates that are for the pension plan.
All right, so I guess we'll just dive into the material here. So I'm going to go first. So again, David Takearts. I've neglected to mention I've worked at CalPERS for about 7 years, and as I said, I'm sort of a spokesperson. So what I'd like to do as sort of like an intro to this material, I know that you've been, and many of you have probably attended all of the pension-related sessions that the city's been putting on. I want to applaud the city and you, the public, and the elected officials for doing that. So much of this information is complex and kind of opaque to somebody who isn't directly involved in it. If you haven't personally if you didn't have a pension going through your public service career, it can seem kind of like a black box. CalPERS itself can seem kind of mysterious and just like this nebulous force in Sacramento that doesn't have a face to it. So I'm one of the faces of CalPERS. So what I want to do here, our presentation is basically divided into two. I'm going to talk to you about what's going on at CalPERS sort of at the big macro level. So what's going on in terms of the overall financial performance of the system, of the fund, and what's going on in terms of the people who are guiding that ship forward in terms of the investment performance of CalPERS. What are the priorities? What are the risks that the CalPERS board and executive leadership team and stakeholders are really looking at? What are those considerations? And try to describe to you the complexities of this equation, because very little in this CalPERS story is purely black or white, or can be explained in one simple sentence. You've probably had a lot of questions as you've gone through this process and kind of been surprised as you peel the onion. There's more and more of like, wow, I didn't realize that's quite how it worked, or that was available or not available. So I want to kind of pull back the veil a little bit. Then I'll turn it over to Kurt, the actuary, and he'll go through things specific to the City of Yuba City. So specific information about your pension costs, the obligations, the unfunded liabilities, what that means for the people who work for the city and for the citizens of this city. Okay, so that's the rough breakdown here. Feel free to ask questions. I think you'll see that there's some kind of like natural breakpoints, and I'll pause and give you the opportunity for sure. So, yes, so my boss Kelly is here, as you said, to take credit for it, but then also to help out with mic running here. So if you have questions in the audience, so that the folks who are watching or the streaming video can hear, and the folks in the room. So let's get into these fundamental concepts and investments. So real high level here as far as CalPERS. So CalPERS is the largest pension fund in America, one of the largest in the entire world. So 1.9 million members, which includes beneficiaries, survivors. It's roughly broken up in thirds in terms of what types of employers do these folks work. They're all public employers, number one. No private companies are part of the system. Yuba City is considered a public agency in this diagram, kind of that middle chunk. So that's cities, counties, and things like park districts and other special districts like that, as distinct from state of California employees. So folks who work at the DMV would be called state employees. A lot of folks are surprised that the biggest chunk of CalPERS members are actually school employees. There is a entirely separate system for the teachers. Okay, so called CalSTRS, it's in West Sacramento. But everybody who's not a certificated teacher at the public school districts is actually a CalPERS member. Okay, so you can have folks working side by side in the school district, and one has a pension through one system and one has a pension through another. And they're actually the largest cohort. There's a lot of schools in California. Okay, so that's the rough breakdown there of the membership. This slide depicts the levers and who has control of what in the overall CalPERS pension decision-making world. One common thing that I hear quite a bit is something along the lines of, well, why doesn't CalPERS just do X? Or stop doing Y? Okay, that's very, very common. And that goes to the fact that a lot of folks don't understand what are the auspices of CalPERS and what aren't. What are levers that CalPERS does and does not have control over? So I try to break it out here. And I think even within CalPERS, we can sort of bifurcate the CalPERS board, which is equivalent to a city council. Elected, it's a little bit different because there are some appointments, so the governor can appoint some. Some folks serve in what's called an ex officio status on the board, so whoever is the elected state treasurer is automatically on the CalPERS board, for example. Okay, but there's 13 members of the board. About half of them are elected from the membership. So these are folks who have pensions in their own right because they work for a city. So right now, there's a board member who's a police officer from City of Corona, which is in Southern California. So he was elected by other people who work for cities. Okay, there's one from the state employees, there's one from schools, there's one that's elected by everybody, or two actually, retirees, et cetera. So there's 13 human beings who make up this kind of mixed board of administration of CalPERS. And you can see there what their responsibilities, what the levers they have are. Perhaps the most compelling one is that the board has a fiduciary obligation to administer the fund in a way that's most beneficial for the members of that system. Okay, this is a not inconsequential point. For the members of the system, not for Joe taxpayer, and really not for city management. Their fiduciary obligation, meaning they would be sued if it could be proven that they weren't operating in this capacity, is to act in the best interest of the members of that system, the 1.9 million people and their families who are drawing or will draw pensions. Okay, so that is critical to understand. The other thing that the board does is they set the risk tolerance of the investment fund. They are the ones who say, okay, based on the financial markets, here's how much risk we are going to give our investment team. Here's how much leeway we're going to give them in order to make the returns that we need. Either they're very risk tolerant or risk averse. And it really depends on the makeup of the board, but really more importantly, it has to do with what does it take to get the returns that we need to pay pensions? And also Kurt will elaborate more on how those two things are connected. But they basically, these elected officials of the board turn around and tell the 100 people that work in our investment shop, we are X or Y percentage risk tolerant or averse right now. So you put forward an investment portfolio that captures the essence of that. We want it to be very risky, not risky at all. Always it's somewhere in the middle, really, it's a spectrum. And then the third thing that the board has total plenary, meaning full legal and no one can really stop them without a lawsuit, is they have the ability to set the investment asset allocation. Okay, what does that mean? This is where they set the percentage of the investments in the fund that are stocks versus bonds, or real estate, or cash liquidity, or private equity. These big categories of investments. Okay, not Amazon stock. They can't say, okay, I want it to be 0.11% Exxon stock, Amazon stock, Disney stock. It's not that. It's the big segments of investment, okay? Real estate, public stocks, private equity, okay? They have the ability to say that. Not the governor, not CalPERS staff, not anybody in this room, nobody, but the 13 members of the board. And that's right in the California Constitution. So that's their role right there, those three. CalPERS staff, so the 2,800 people who work for the board under the CEO, our job is to, number one, to administer the pensions, meaning calculate how long people worked in public service, calculate that, store that all up in our computers, and then when a person goes to retire, we calculate what's the exact amount that they're owed by virtue of their formula. So how long did they work in public service? How long did they work? What was their multiplier and what's their age? And that spits out a number. Okay? Our job is to get that number right and pay it out until that person shuffles off this mortal coil. And then if they have survivors or beneficiaries, then we transfer some percentage of that onto them. That's the number one thing we do. Kurt and Ian, their job as actuaries is to calculate the cost of those pensions. Okay, so if we know that a person just started work today and they're 22 years old, they calculate how long that person is likely to work, what their likely salary will be, and how long they're likely to live in retirement. And from that, they can calculate how big their pension check should be. Based on that, they then turn to the city budget and say, City of Yuba City, we need you to pay us this amount of money this year in order to cover those costs. Okay, so that's what an actuary does in a nutshell. Kurt can do it a lot better than me, but that's the essential piece. And then the third thing that CalPERS staff does is effectuate the investment strategy that the Board of Administration lays out. So the board tells us we want to have a 65% risk tolerance in there, so we want to be, somewhat aggressive in our risk in our investments, and we want the allocation of the fund to be 50% stocks, 13% real estate, and the other percentages. You guys make it happen. Find the best investments in those categories that will pay that out. That's what the investment team does. They cannot go to the board and say, hey board, we don't like your strategy. We're going to go 100% Amazon stock right now because I think that's going to go through the roof. Cannot do it. Okay, the board has that ability only. All right. So that's what CalPERS can do right there. That is where, if you're like, well, why doesn't CalPERS just do this? Look at this chart, those things on the left, that's what CalPERS can do. When you look at the legislature, okay, so I'm talking here about the state Senate and the state assembly, and then really that legislative process that crosses the governor's desk, that whole process. The things in this box are things that I bet a lot of people in this room think either were or should be in the CalPERS box. Am I right? Did anybody here think that CalPERS has the ability to set the pension benefit formulas from which cities or employees can choose? I'm not asking for a show of hands, but I bet you someone thought that CalPERS decides what the pension formulas are. Or that we can make and change pension laws. That we can simply say, well, if a city's budget is is too stressed, then CalPERS can say, well, you can just take 50 years to pay it instead of 30 or 25. No, CalPERS does not have the ability to just arbitrarily do these things. It would have to go through various processes. And perhaps most of all is the benefit design changes. So the ability to simply say, listen, we think that the pension is too expensive for these folks, especially firefighters or police officers. It's just too expensive, can't afford it. So instead of a 3% at 50 formula, now it's going to be 3% at 57. Okay, everyone has to work 7 more years. CalPERS cannot do this. CalPERS does not have the ability to do that, period. You could literally put a gun to the CEO's head. She cannot do that. Okay, that is not a lever that CalPERS has access to. Okay, other decision-making abilities in this equation. Employers, okay, so like the city. Employers have the ability to select their pension formulas. Now, to be fair, they selected it probably many, many decades ago. Okay, so the pension formula, what I'm talking about here is for safety, 3% at 50, 2% at 60, these types of things if you're engaged in it. So like what the calculation is used to finally come up with the formula based on a person's salary and years of service. So the city chose that at one point. The city can set the salaries, and of course, and most importantly in this equation, the city makes contributions to its employees' pensions, okay? And make no mistake, those costs have been on an upward trend, okay, for really at least the last 5 years, and they're projected to keep going up. This is the concern, and it's real. It is not being fabricated, I assure you of that. So but the employers do make those contributions. Employees, okay, the people who look forward to drawing these pensions, they make contributions as well. Okay, so from every paycheck, there's contributions that are paid out towards their own pensions. The employees have the ability to select their employer. If they don't feel that the retirement package is attractive enough, there's no law that says they have to work for the city. Okay? And then they also have the ability to collectively bargain salary and even optional cost sharing. And maybe Kirk can talk more about this, but there is discretion within the collective bargaining process between employer and employee for both sides to come together and recognize, listen, based on what we know about the facts, about costs, about all these inputs, they have the ability to say, I will pay a little bit more of the pension. That is on the table. Okay, and it should be known. So that's something that's there for employees who may be concerned about the sustainability of their own pensions going forward. And then lastly, the kind of like most mysterious of these levers is the courts. Okay, so they really rule on and decide on questions of pension law. Highly unlikely that the courts will just do this like out of the clear blue sky. Really, one of these stakeholder entities, if we want to call it that, some representative of employers or employees or would likely bring a question to the court. So right now, the thing that the state Supreme Court is at some point going to rule on has to do with the question of what's called the California rule, which I suspect Dane Hutchings from the league likely touched upon to some degree. So this is, the California rule is a long-held legal precedential decision that's so famous for its strength in California that it's known nationally as the California rule because of how often it's been upheld. But it essentially says that the pension benefit formula that you get on day one of employment, if you stay with that employer, that's what you're going to get on the day of retirement. It can't be lowered. It could be increased. It can only be lowered if it's offset by something compensating, and there's really nothing that people would say would compensate for taking away a pension. So in effect, it means that what you get on day one is what you get when you retire. Okay, so that is being challenged by the courts. CalPERS is not directly involved in this. The court cases are not even about CalPERS pensions. They're about two county systems that aren't even part of CalPERS. But it could have an impact on CalPERS, and then thus it could have an impact on the city here at some point in the future. But there's a lot of ifs there. So I would not put any eggs in that basket. There's not even a date for when the courts will meet on the issue. That's how far off this is from being a real material reality. Okay. Here's how the fund is doing. And when I say the fund, I'm referring to the combined pot of $380 billion right now, the combined pot of all the contributions from all of the 3,000 cities in California and all of the more than 1 million active employees that make the contributions, and all of those that have been around for the 80 years that there has been a CalPERS. All of that money is combined into a pot called the PERF, the Public Employees Retirement Fund. It's a pot of huge money that is then invested. This is how that fund has done over different periods of time. The most relevant ones for today are the one on the far left, so how we did the last fiscal year. So CalPERS goes on a fiscal year basis. This number is very important because it determines, really, it's perhaps the most important number in determining what this city's contribution requirements will be down the road. So for us at CalPERS, it's more complex than this, but for us right now, the magic number is 7. If CalPERS hits a 7% return rate, then our current projections are spot on accurate, and that is at least, while costs are projected to go up, it's at least not a surprising rise. Okay, anything less than 7 and costs will go up from the employers at some point. Okay, in this arc of payments going out 25 years. Anything over 7 is very, very positive for everybody in CalPERS. The employers root for this, employees root for this, and I assure you CalPERS staff and board root for us to beat the 7 mark every single year. But we know it's not possible. We know that there's going to be some kind of variance there because nobody can beat the market every single year consistently. Nobody. Okay? Anyone who says that they can is lying. Okay? It cannot be guaranteed beat every single year. If it could, we would put all of the money there. I promise you that. So we did 6.7% last year. That's not 7, it's a little bit worse. It's not terrible, and it actually beat some predictions, so that was nice, but it wasn't 7. That means that the city's costs are a little bit higher going forward than they were last year. Okay, when we returned 8.1. Or 7.6 last year.
Excuse me for just a second, please. I wanted to let everyone know that this presentation will be available on the city's website. I noticed somebody taking a picture of the slide. We'll make it all available to you on our website so you can access it later. Thank you.
Thank you. The other number I want to point out here is on the far right. Okay, the 8.4% return, which is that's our performance over the last 30 years. 30 years is CalPERS' sweet spot. CalPERS really is a long-term horizon investor. This is our strength, okay? The ability to get invested into not just companies, but into whole sectors of global economies, get our money in there early and wait for profits over decades. Something that Wall Street firms, they're on a 3-month timeline. If you can't make returns on a quarterly basis, your clients will jump ship, okay? Our clients have no option to jump ship, and we're investing to exist forever. The CalPERS fund is designed to exist in perpetuity. As long as there are local governments with pensions paid to their employees, there will be a CalPERS. That's the design. And so we have this very, very long time horizon. What this means is that we cannot be nimble and day trade. We do not exit in and out of stocks quickly. And this is a frustration to a lot of stakeholders, especially stakeholders who believe that CalPERS shouldn't invest in certain companies based on actions that they read about in the newspaper last week. Why doesn't CalPERS immediately sell its whatever, Amazon stock, Google stock, any company related to anything, whatever your issue is? Everyone in here has an issue. You're like, I hate that issue. CalPERS shouldn't be a part of it. Even if these are exactly diametrically opposed positions, it's there. And trust me, people want CalPERS to take all of these contradictory actions. And our position is always, we need to be investing, we need to be thinking long term. We can't just be divesting immediately because of something that happened. We're going to lose out on our only advantage. Okay, we do not have any ability to quickly pivot between any investment and hope to be even close to returning a 7% return. Our only strength is the ability to get the money in and be patient over time and allow the compounding effect to take place. That's our only strength. That's the only hope for everybody to keep the pension costs containable. And so that's really why people are disappointed a lot with CalPERS that why didn't you sell all of your Exxon? Okay, I don't like fossil fuels. I have a genuine belief that it's terrible. So sell immediately. It's exactly at odds with the prior slide. Remember, the very top left one on the board, their fiduciary obligation of these people is to make investment decisions that help the members. Okay, so while it would make everyone feel good to immediately divest from cause-related issues, it's not really in the fiduciary definition. And so we have to resist that. Okay. why don't I pause there for questions before I dive into this?
I have a question.
Sir.
You said sometimes it seems that the process is opaque with the pensions. On a scale of 1 to 10, how transparent do you think CalPERS has been in the last 10 years?
First, I would say I'm going to draw a distinction between the last 5 years and the 5 years before that, because I think it would be fair to say that many meetings like this probably were not happening, especially at this level. So someone like Kurt might go out and have been talking to your city manager and finance director, but would it have been a forum like this? Probably not. We've had a new CEO since then. We've had basically a complete turnover in executive leadership with an entirely new mindset and a recognition that the CalPERS related costs and obligations, while the most direct concentric circle of impact is on the members, there's a clear impact on the constituents of the communities where those employees work. And so I would say that it has really done maybe not a 180, because it's not like it didn't happen at all, but it's become a much bigger priority in the last 5 years. Sir.
So I was just on the California website today, California State Government, and it was announcing, and this actually was, I think, September 20th or thereabouts, that Governor Newsom had signed an executive order directing the California State Director of Finance to come up with I'm going to call it a scope of investment that would direct the assets of CalPERS, CalSTRS, and the university retirement system to put more funds into, and I'm going to say, eco-friendly investments. Mm-hmm. That seems to go at odds with what you said about you guys are in control and you don't listen to the governor, et cetera.
Well, let me go back to this slide here. So if you look at, I do have a pointer here actually. What makes the situation less than black and white, as I said, is this one right here, that the legislature, and let's include executive orders from governors kind of in this like politic type section, make and change pension laws. So if it suddenly becomes the law that the board can't do a certain sector of business or must do something, then that sort of changes the flavor. This one is not as hard written as maybe the press releases that went out or stories would indicate. So it does order CalPERS to consider climate-related factors when making investment decisions. I assure you, CalPERS already considers climate-related factors when making investment decisions. That is not at odds with the fiduciary obligation. So it is the position of our investment team, and as far as I know, all of the board, or the vast majority of the board, that climate change is a real direct present factor in decision making when it comes to investments. So for example, if we're presented with a real estate deal on a coastal area in some part of the world, and we think that maybe that area will be under a foot of water in 30 years, that is a factor that goes into that decision making. So this executive order, we don't see it as the governor taking away our plenary authority. So governors are apt to do things, but the California Constitution speaks for itself when it says who actually can make the raw decision on investments.
All right. I want to follow up on that if I can. Dave Shaw, sorry I'm late. I'm one of the councilmen. Also, so you know, I'm an RIA, an EIA, and a life agent, so I'm very well versed in all of this. I happen to have, because it actually, I was forwarded the press release from Mr. Layton there. And I was going to question that as well, because understanding the board's position and having a fiduciary responsibility, understanding that the governor does not, and I don't mean this in a negative tone, I'm not trying to put you on the spot, I'm trying to help everyone understand the relationship and what CalPERS is going to do here. The press release itself that he put out said that it was to focus on more, I can tell you exactly what it said here. Adoptive information climate policy, state investments that's aligned with the reality, blah, blah, blah. It's a climate investment framework. Basically, the green friendly stuff. With that, it also went on to say that the primary goal of CalPERS board is not to do what is in the best interest of its stakeholders, which is the members of PERS, which is maximizing the return. That's no longer maximizing the goal that needs to be reached. There is no longer the directive. It's now being eco-friendly. And I realize this is coming from the governor's office, and I realize politics are involved. But this is the stuff that the public has to weed through. This is the stuff that the municipalities have to weed through, because being well-versed in that profession, I understand very well that that board, whether or not they understand investments, they're on the board, and they set the investment policy. Why are they allowing information like this to drive their investment philosophy versus doing what their fiduciary responsibility is, which is reaching the goals of taking care of the stakeholders? Can you help explain that?
I think that the board and the staff I know for a fact that we did read the press release at the same time as everybody else.
Right.
So I can say that in all candor. But CalPERS has been kind of like out in front on this climate-related investment impacts issue for a long time. So CalPERS is part of several large coalitions of very large institutional investors. So we're really the founding member of this group called the Climate Action 100, which represents well over $3 trillion of institutional investment money from around the world, with the focus on getting money into places that are at once eco-aware, let's say, but also meet the fiduciary obligation and have a realistic expectation of producing that 7% return that we need. So it was a little bit of a surprise, I'll just be honest, but we don't feel that they're a direct oppositional control. We don't think that there's going to be now our board needs to march over the governor's office and tell him, how dare you. It's not quite that, because I think, as you said quite savvily, there's just politics involved here, as literally the next week, the governor was speaking on climate change issues at a UN climate conference. Okay, so this is just, we don't see this as a existential threat to the board's ability to make investment decisions.
I appreciate your answer, and I'm going to throw you a lifeline on this, because
Thank you.
I'm trying to help them understand that just because the governor issues an executive order doesn't suddenly mean that we get out of oil and we get out of all these things, because I manage a small percentage of what you do, actively manage. And with that, can you tell me what percentage of the overall portfolio is geared towards the eco-friendly stuff? Is it probably 5%, 7%, 3%?
I don't know. I think that the term, eco-friendly stuff would be difficult to define. I know that a big effort right now at CalPERS is to really blend this type of thinking into all of our asset classes, and that's made it even harder to suss out, okay, what percentage could be classified as this or not. But certainly CalPERS has enormous stake in companies still that I think a lot of folks who are extremely climate change conscious would be surprised that we are, given our position. But that's because we have a firm position in the investment office that change of these industries will not occur by CalPERS selling its shares. That will do exactly nothing at all. So CalPERS has really modeled what's called corporate engagement, where as a shareholder, as a large shareholder, and as the head of these big investment coalitions, we have the ability to basically force our way into these corporate boardrooms and have our say and really actually try to effectuate change that could have these sort of societal benefits that I think are the ultimate goal. So staff is pretty firm in our resolution that simply a feel-good divestment followed by a press release is not nearly as impactful long-term as actually doing the work of engagement with these companies and these industries long term. And so that's not popular. That's not sexy at all, what I just said. And so we get a lot of flack for that, but that's something that we're pretty committed to.
I will close out and then give it to the mayor because he's got a question as well. And but your class, CalPERS is classified as a market maker, and they have different rules it has to be adhered to. So you're absolutely right. You can't divest of a position very quickly because of the amount of market momentum that is shifting and moving, and there are some strings attached there. So I appreciate your candor. Mr. Mayor, you had some questions yourself.
It was pretty much already answered. I had a question, David, on the same thing with the investments. It seems to me that some of these directives for where CalPERS invests their money has become more politicized than based on looking at the profit. And I know folks in this room are kind of frustrated with that. We're trying to maximize the profits, but yet we need to focus on something that's political. I don't know if they're paying attention of what's going to be profitable or not. But I just wanted, the question has been answered since this exchange here, but that was going to be my point. I share that frustration with some folks. I know that.
And I can appreciate that. I do see, if I could just respond. So I think the question was originally like, how engaged has CalPERS been, or like breaking out of this black box kind of like motif. Over the last 3, 4, 5 years, we've heard levels of magnitude more engagement from employers, and a lot of it on that issue. Like that's really the crux of what we've heard from folks like Dane Hutchings of the league, or the new firm is in, and like other representatives of counties and other employers, folks who are looking at the bills attached to these pension costs and saying, we recognize, or we can have our personal beliefs about the rightness or wrongness of the causes that we're talking about, but bottom line, the returns need to be made. I mean, the pension fund needs to perform to fund these benefits that we're on the hook for. So that message has really come in loud and clear from the employers more and more, and it has resonance. The board hears that. The board hears that, if employer budgets are strained to a point where they are actually considering not paying their pension obligations, where that is actually being discussed, that is like an arresting thought. That is, wow, because if the member's benefit is secured only by the employer's ability to pay. And that's something, I think some scales have fallen from eyes there over the last few years, in that these are not guaranteed benefits. The word guarantee needs to be eliminated from the lexicon. It is dependent on the continued contractual obligations with the employer. So the board is hearing that, so keep saying it.
If I can follow up with a couple of other questions that might be some of the questions that they have in here, because these have come up over the series. And Elaine, we'll give you guys plenty of time. I've got a list of things that we've been building here. But one of the things that surfaces before we get to the actuary is, how is the cost for having PERS and STRS, you can say for that matter, but we're talking about PERS. How are those costs paid for? Is that a line item out of the general budget from the state that covers all the salaries and the pensions and the health benefits? Or is that coming out of a management fee from managing the funds, or is it a combination of both? And the second part of that would be, if there's a management fee on, back to, you said 360 billion, the governor said 700 billion, whatever the number is it 0.5%, 1%? Can you put that together, because people are trying to figure out the cost that it takes to operate PERS as well?
So the cost of the administrative cost of the fund is borne by the fund itself. So it doesn't come from the general fund, other than CalPERS also has like a healthcare side that's completely apportioned off. So there are some general fund monies coming into CalPERS, as well as there's also a few other kind of like side operations within CalPERS, but the overall like administration of the fund is borne, and the employees that administer is paid for by the trust itself. And that's, I want to say it's less than 1% for the entire kit and caboodle. So all the employees and things like that. So I don't know exactly, there may be some other money pieces to this that I'm not fully cognizant of.
I think we got the answer maybe coming here.
Yeah, so to administer the pensions, we're just talking about the pensions, the money comes from the trust, like he says, and we charge it across the assets, similar to the way a mutual fund would charge
The 12B1 fees, yeah.
So it's about, our assumption is it's about 0.15% of the fund. It's been running between 0.1 and 0.15 for many years.
Okay, and so there's no subsidy coming from the general budget from the state of California at all. It's all from the management of the funds. And then the last question that I would have goes back to something you mentioned earlier about there's no way out of a guaranteed benefit pension by just saying we're going to reduce your benefits. We have had a couple of cities here in California that has gone through the bankruptcy process, and it's actually been brought up in this room even in our very first meeting. You know, we see the only thing happening is every county and municipality in the state to go bankrupt, and where do we go from here? If a municipality of any sorts or a school, you know, anything under PERS goes bankrupt, what happens to the pensions of those employees of that municipality? Because they're obviously no longer paying into PERS.
Right. So there's been a couple of examples of this, and they've gone kind of on a spectrum of how far they went down the path. So I think some large cities that those of you who've been in this for a while may remember, like Stockton, Vallejo, San Bernardino. So these cities did enter bankruptcy. They got pretty close to looking at like basically defaulting on their pension obligations. When it all got sorted out, that was one of the few debts that they did end up keeping whole. So they would have defaulted on things like bonds for bridge construction, things like that. So for those ones, nothing happened to the pension. So those people were made whole. Then in the last couple of years, we've had some smaller, not anything close to the size of Yuba City, but a JPA, which is a Joint Powers Association, and then a city that no longer had active employees out towards Truckee called Loyalton, wherein essentially the entity did go bankrupt. They stopped making their payments for whatever reason. What happened, and I want to be perfectly clear on this, is that the CalPERS board followed the law and reduced those people's pensions commensurate with their funded status. That is what happened, and that is what would happen to every single other municipality that, for whatever reason, did not make their payments. So let me boil this down to cold, hard fact here. So if the city, and I won't even use Yuba City because it's too terrible a situation to even envision, but if a public entity were, say, 40% funded, like they were in financial crisis, they only had 40 cents of every dollar that they needed to pay pensions, and they went through bankruptcy, and that was it. The entity dissipated. There was no more city. Then the active employees then would be terminated. Their pensions would be shortened, and when they went to retire, they would receive 40 cents of every dollar that their formula dictates they would. Yeah. Perhaps even more unpleasant to think about is that the current retirees, people who have already retired from that city and were drawing a full pension, let's just say that it was $1,000 a month, just for the math. They were already drawing a pension, okay? They're 85 years old, whatever. Their pensions would also be reduced by $600 to $400 a month going forward. That is what would happen.
Thank you.
Yes.
You mentioned that CalPERS has plenary powers, the Constitution. I'm sorry. That means that you don't have to kowtow to the governor, and you are a pretty powerful agency. And so you understand that if anything goes wrong, the agency is responsible in large part. So
that's correct.
Can you expound on that? What the plenary powers mean?
It just means that if push comes to shove, they have the ability to do it. And, far be it, we're talking here about some of the most powerful people in America here. Not the board, but I'm talking about governors, these are powerful entities. Everybody has political agendas. So things are going to happen. When push comes to shove, the CalPERS board has the ability to make the investment decision. Yes.
First of all, I do appreciate you people coming up here. I've been harping on the pension issue since 2004, and it appears to me that so many times the public are misled. I think a lot of things are written up by PERS and by the cities and counties, and they really don't tell the truth. I'm not picking on you, by the way, but one of the things you said was that over a 30-year period, you had a 8.4% return on investment. The pensions increased in 2004, I think, statewide, because of all the contracts the cities and counties were able to make. If you take a 20-year period for return on investment, it's 6.1. The 8.4 is made because prior to 2004, there was excess monies at PERS, correct?
Yes, I'll grant, yes.
So the thing is that the problem is the word defined. Defined is the big problem. It's always stuck in my throat because we always used to say that death and taxes were two things that were going to happen, but defined comes in before death and taxes, according to what the public have to put up with, correct? So,
I can't change that aphorism, but I get your point, yes.
but the thing is that what I would like to see is, first of all, this is the first council group that I have attended, the first council group since I've been looking at the pensions, which went up in 2004, that have decided to let the public in on what's happening. I think our mayor has done a hell of a good job for us. But I think what must happen is that the public must be educated, even if we have to take out ads in the paper telling them that we have only got 65% funding on our pension. Get rid of all the fancy words like unfunded liability. Tell people we're overdrawn at the bank and we're paying interest on interest. The public must be brought into this, and you know, there is no such thing as, in my opinion, there's no such thing as a guaranteed retirement. When you look at what we have in this country, a fireman goes to work at age 25, and after the first year, he's probably making about 80, maybe 75 grand a year. At the age of 50, he's probably at 125,000 a year. But the wonderful thing he has to look at is that his salary is going to go up every day after he reaches the age of 50 by not working. Now, when you take a look at the way I look at things is that you go to work at the age of 25, and then you get married, and you have kids, and you get a mortgage, you get all of these additional expenses, and you work your tail off to cover those. But at the age of 65, and you're just about ready to croak, you have just about reached everything, but your expenses have gone down. But what we've done today is say, well, okay, when you're ready to get a pension, your salary is going to go up forever. So what I would like to see happen on behalf, what I would like to see PERS do, and I'd like to see the city do, start taking out ads and tell the people the truth, because we are looking at bankruptcy. There's no way out. If we were bankrupt in 2004 when this first went in, but nobody would believe. And as I say, I'm not a specialist in any of these pensions or anything, but common sense has gone out the door. But once again, I really do appreciate you people coming up, because for a little city like this to have you people come up, I think is really a feather in our cap. Thank you.
Right, thank you, and thank you for your comments.
Just real quick, I'm going to let you go. I just want to let everybody know we're about a 10 or 15-minute warning right now before we run out of time. So enjoy.
We don't have our meeting till 6:45. So when you said there's 13 members on the board, how many of them are actually ones that we can elect, and how many are appointed by whom?
All right, let me do this here. So are you a member of the system right now? That would change my question. Retire the system. So that means that there's two members who are elected by the system, the members at large. So whether you're an active member or a retired member, any person in the system can vote. And then there's one from the retiree community. So only a CalPERS retiree could vote for them. And that just completed last week. Then there are, so that's three. Then there's one elected by active members of the school, one by active members of the state, one by active members of the public agencies community. That's the police officer in Corona that I mentioned. Then there's the state treasurer. There's a state controller. And so those people run on statewide elections. Everyone in this room had the opportunity to vote for them, okay, on the gubernatorial ballot. So that's Fiona Ma and Betty Yee. Then there's the director of CalHR, so that's a governor-appointed position. There is the person appointed by the governor to represent local government. So that's one of particular interest to the city often. So that's that's a recent appointment. There's one appointed from the insurance industry, so another recent appointment. Then there is one who is a governor appointee to the state personnel board. So you're hearing the word governor a lot here. So right there, you're kind of understanding the political kind of like backdrop under which the board operates. Okay. Oh yeah, the one appointed jointly by the legislature. Yeah, that's right. I believe that's 13. How long is the term? 4 years. 4 years for the kind of elected office ones, and then the appointee ones are at the governor's pleasure.
David, I know you have the rest of your presentations to go, so if you maybe we can do that.
Sure.
Give you that time.
Certainly. Okay, so I will try to make this quick, but I just want to address real quick that perhaps some people have a fundamental question: why, why is it that why is CalPERS performance not consistent, or why can't they consistently beat the 7? This guy just said nobody can beat 7. Why is that? Why, I beat 7. The S&P 500 is up 20% this year. Why isn't CalPERS up 20%? Okay, fair question. Here, this chart, if you can read it, I know, apologies, it's kind of hard to read and there's a lot going on, but I'll interpret it. I want to direct your attention first to this kind of like dashed line right here. This is the 10-year Treasury yield. So for layman's purposes, and the financial consultant will be able to nitpick a lot of this, but let me just give it to you in layman's terms. So this is essentially virtually risk-free investments that CalPERS or anybody can make. Unless the United States of America is conquered and dissolved, this will pay. Okay, so if you look to the left axis here, this dotted line, this is connecting to the investment returns available going back to the 60s. Remember, CalPERS is a generational investor. So like our pathways are really carved down decades, half centuries long hallways. So for the longest time in the 60s and 70s, this dashed line, you can see we were getting 10, 8% up to an incredible 15% return on investing in things that were virtually risk-free. So I can do that, okay? Any of you can make that investment and hit the 7%, okay? No problem. The problem is that starting here in the mid-80s, you can see that the return on these risk-free investments is in steady decline, and right now it's somewhere, reading over here, somewhere in the 2.5, 3 or somewhere range, okay? So moral of the story is there that the available pool of free money or risk-free returns that would do what CalPERS needed has almost entirely evaporated. We cannot park the $380 billion in Treasury yields and hope that returns 7 when it returns 2.75. I mean, the math does not work. It will not pay. Okay, so if you look into the background, see these kind of like waves, looks like radio waves or something in the background? That is the percentage of the fund by allocation. So if you look on the right side, here's the various asset classes of CalPERS. So fixed income, which is like bonds, and it includes boring things like those 10-year treasuries. And then, so if you look here in the 60s, 100% of it was this kind of like gray background color, meaning all of the money, all of the pension fund was in risk-free stuff because it paid. So why take a risk on stocks? Then as those went down, you can see as this dashed line goes down, you can see that the percentage of the fund that is in these other colors, which is public equity, so stocks, okay, private equity, investing in companies that haven't gone public yet, okay, like WeWork, which is a disaster now, but real assets, real estate, cash, inflationary assets. You can see that now suddenly fixed income, the bedrock of pensions for decades, is now just like 25% or so of the fund. Okay, that is the story right there. These other lines, this dark line is the CalPERS discount rate. That's right, which is right now that 7%, that magic number that we need to get in order to pay the pensions at the calculated rate. Okay, that number did not drop precipitously with the decline in free money. Okay, it just kept going. That's a big problem right there, is the assumed rate of return was not immediately lowered, okay? Human beings didn't want to make that decision because it immediately raises the cost for everybody, and nobody wants to pay now when they can pay later. Nobody. That is human nature. Whether it's credit cards or pensions, no one wants to pay right now, okay? Then The other thing that you see here is this line is the rolling 10-year return of the PERF, which is the $380 billion fund right now. So you can see that when times were good, it roughly paralleled with and got up to as high as the 10-year Treasury fund. But as we had to diversify, we got more exposed to risk. We got hammered like everybody else in the great financial crisis of 2008. You can see right here. Look at our returns. Okay, not good. Because we had a negative 24% year, and that takes forever for a pension to dig out of because we're so slow moving, okay? Because we can't just put it all on 22 black in the roulette table and get healthy real fast, okay? It's so incremental, okay? So this is the story of why CalPERS is currently 50% stocks, okay? That's far more than the CalPERS board would like. We'd love to be 90% bonds, treasuries, cash, gold bars, anything other than stocks. But we can't be because we have to achieve the 7% return. Okay. Almost done, so I'll zip through here now. So 3 key risks that the board and the staff have been tasked to manage and have to worry about here. My icons didn't come through, so you get 3 identical blue dots, which mean nothing. So the main risk that we have to manage is the investment risk and liquidity. So the number one thing that impacts the whole system, whether it's the employee, councils of cities like this, or the entire state of California budget, the number one thing, the thing that shakes everything is the investment return. That's the number one thing. So that's where CalPERS is focused. That's paramount. Attached to that is the knowledge, the sad knowledge that these markets are cyclical. We know that at some point there will be an end to what has been really an historical bull market in stocks. This will happen at some point. Love to be wrong on that, love for it to go to the moon forever, would love that. But we cannot hope on that as a strategy. That is not prudent. So we have to have liquidity, meaning keeping some either cash or quickly fungible fixed income assets on the side that when there's a market dip, we're going to sell that and buy those stocks on the cheap. Buy low and sell high. That's how it works. And it's the easiest thing in the world to say, and the money manager knows it's the hardest thing in the world to do. It is so hard. That's why we're trying to institutionalize it at CalPERS so that when it happens, it's not the sky is falling, what are we going to do? We're not funded. It's going to be, to a certain degree, sweet buying opportunity. That needs to be our approach there. So that, because again, we're looking at 30 years. Okay? So that's a risk that we're managing. I mentioned already the climate risk stuff. So this is why the governor's executive order didn't paralyze us with terrors, because we've been working on this. We are cognizant of it already as a threat to the portfolio. It's being worked into our investment strategies right now. And then lastly, and probably top of mind for this group here, rightly so, is employer affordability. It really doesn't behoove any of us to say, I followed by a fiduciary obligation if half the cities in California go bankrupt and people don't get their earned pensions. Okay, that doesn't really help either. So that is not what success looks like. So we need to be working with employers, giving them the tools, giving them information at least so that their informed citizenry and stakeholders can have conversations like this. And then when you reconvene in months coming up, you can decide what to do to address the realities that you now are aware of. So these are things that are really keeping our CEO and our board up, and probably a lot of you folks in this room. A real quick look here at where the money comes from for pensions. Okay, so there are exactly 3, not 4, not 5, 3 sources of where the money for a pension comes from. So if you took all the money paid out in all the pensions, okay, so we pay out about $22 billion a year in total pension checks. If you boil that down to $1, here's where the money came from for that dollar. 59 cents comes from investment returns. Okay, so the money compounding over the years being invested. So that's the biggest chunk. 13 cents on the right comes from the employee's contribution. Okay, so the employee has direct skin in the game for sure. The one that fluctuates the most and causes the most angst for finance directors is the employer piece, the 28 cents, okay? Because here's the thing when it comes to pensions, the defined part that the gentleman was mentioning. The defined benefit means that the pension buck, the full dollar, has to be paid out regardless of market conditions, regardless of whether or not stocks are hot, hot, hot or not. Okay, the full buck gets paid out. If the investment returns are not hot, if really that year's buck was 57 cents, that 2 extra cents has to come from somewhere. It's not going to come from the state. It's not going to come from Trump. And it's not going to come from some other city either. It's going to come from the employer budget right in the middle of this buck. It's going to come from the 28 cents. That will go up to 30 cents that year. Okay, that's how it works. That's the strain on employer budgets right there, is that they are the backstop. The employer is the backstop against negative or poor investment performance. Okay, the employee is really not, unless an agreement has been struck, unless there's cost sharing. Okay, slight exception for the newer employees, PEPRA employees they're called. They do bear a little bit more of the risk, but let's just call a spade a spade. The employer covers the difference if the investment performance isn't there. That's why it's so important that we get our investment nut. We have to make sure that we hit that. Okay, and so we want to be able to do that. Here's the funded status of the whole system. So funded status means percentage of dollars that we have versus what we should have in order to pay the pensions. So we are about 71%. So on a spectrum, the typical red is bad, green is good, slightly, in the yellow. Okay, so a C minus-ish. Okay, it is not where we want to be. Okay, so the goal is to get up above 80. That frees up CalPERS to take some risk off the table. That's when we could start entertaining questions about the rightness or wrongness of the investments in terms of causes, things like that. That's when you sort of have some latitude possibly. Right now, it's do or die time. Okay, so CalPERS staff is laser focused on getting this bumped up. Okay, this is uncomfortably close to that orangish reddish. Okay. I've talked quite a bit about this divestment versus corporate engagement. Again, the staff is pretty unified on this, that corporate engagement is a more successful model for effectuating change, if indeed change needs to occur. Okay, so we generally oppose divestment. Sometimes it's the law. Sometimes CalPERS board does decide to invest on their own. For example, in 2001, CalPERS board members, no governor told them to do this. CalPERS board said, we don't think that investing in tobacco corresponds with our fiduciary duty. On the one hand, we have health plans, and then we're investing in cigarette companies. We're going to divest. Okay, so the CalPERS board can do that. And again, because of that plenary authority, no one can stop them. Okay, sir.
Just one more question. It would seem to me that the best investment that CalPERS has is the unfunded liability. The interest that you get on the unfunded liability is better than the government
now
bond.
I see where you're going. I was like, well, I don't follow. Oh, I get it.
I mean, but this unfunded liability, is that included in your overall assets?
No.
Okay, that's what I was wondering about.
Definitely not.
So you have your assets plus the unfunded liability that these counties and states have not paid you, correct?
Yes.
Am I stating a...
yeah, you're stating it's not a common. It's a unique perspective on how that is set up, but I wouldn't worry about that. That's.
Well, my worry is that why should we pay 7% interest when government bonds are 2 3/4% interest? Are we in that much worse shape than the government?
Yeah, it has to do with how we price the.
You can think of the interest charge on the UAL as you're being charged 7% interest on a debt. That's the way the math works out. Now, what's really happening is, the cost of these pensions are calculated so that you invest the money as the person works, and it's invested, and we assume it's going to earn 7%. Well, if it's not invested, we're not going to earn 7%. And just like David said, we got 3 sources of money, right? The investment earnings, the employer contributions, and the employee contributions. And if we don't have money invested, we can't get the 7% from the capital markets, so it has to come from the employer.
Well, my last statement is that the statement I've been making all along is do not pay into the unfunded liability, just let it rise. Thank you.
I'm sure our actuary could comment on that too, but that will not be a successful strategy, and it'll just be, the problem will just grow for future generations. So last slide for me here, I won't even go through all of them, but our focus going forward, I think paramount for us is that the investment returns, like that's where we can do the most good for the city. We as CalPERS can do the most good by getting the highest returns that we can. So we've brought in just a superstar investor named Ben Meng to be our chief investment officer. Our CEO thinks that he's the best hire that we've made in the last 20 years, the most important hire. We've really given him the reins to make the portfolio as streamlined, as sleek, and as efficient a money manager as possible. So we're putting a lot of eggs in that basket. And we just need to be prepared for when the market does take a downturn. And I assure you, when there's a protracted market downturn, when there's more than 3 straight months of negative returns, there will be you think you see media stories about CalPERS now. You will see a dozen stories a day in every single newspaper about how the system's unsustainable, how the whole thing is going to unwind. Just know that CalPERS is thinking about that situation right now and stockpiling liquid cash so that we can capitalize and buy those stocks on the cheap so that when, not if, but when the market recovers, you will reap the financial benefits of that. Okay, that's what your investment staff in Sacramento is planning to do right now. So that's what we can do for the city. We can't make your pension obligations go away. We can't waive the interest on your unfunded liability, but we can be focused on getting the investment returns that will lessen the burden for these costs, which have been promised and which should be paid. And so we're going to do everything we can to make that possible for you. So let me turn it over to Kurt to go into like the specifics for the city. I do see a question. I just want to be cognizant of time for everybody. I'll make it quick.
Thank you. Rick
Yes.
Jimerson. I have a few of those initials that David has as well, and I've actually acted as a manager for pension funds, national pension funds. I've been active in it. When you named the 13 members of that board who make these decisions in the start, and where they came from, I didn't hear any of them having the type of initials that we do or the background. So who is it? I don't mean this in any negative, but who is it that's guiding them? Who's bringing the information to them to help them? Let's say you've got a few teachers, a firefighter, a police officer. Who is it that's bringing and providing the information that helps them make these decisions?
Yeah. First, I will say we do have one professional money manager who's on the board. The government appointee from the insurance company is a chief investment officer for a lending institution called Lendistry. So we got one at least with the initials. And so, I mean, it's a combination. So the board has their investment consultants. The board has the investment staff whose job is to present the information for the board to select from. So that's staff's job is to, and that's the CEO's job, is to hire the right people to make those recommendations. And then they contract out with folks who aren't on the payroll, who aren't beholden to investment staff's opinion about them. They are directly contracted to the board to give them the advice there. Kelly, who's standing right behind you, was a retired firefighter and served on the Washington State Investment Board. So, Kelly, I don't know if you want to comment maybe on the type of investment advice that comes into a lay board, but it is a lay board. Your point's well taken. It is a lay board. Kelly.
Yeah, so to answer your question there, it is reliant a lot on the team of people that we put together, the investment team bringing that information, the knowledge that you have, that the two of you have. They bring that to the board, and then the consultants are the check for the board on whether or not the advice from the investment team is appropriate or is accurate, or whether or not it falls within this maximizing return at a prudent level of risk. And so they do have professionals that are guiding them.
Yeah, but I wanted to be sure that it's not just the staff that's guiding them. Right. So you're saying that there are outside consultants otherwise, because in many institutions, specifically the insurance industry, which I've been on many of their boards, the information all comes from within. Your guidance is inside. Okay, thank you very much.
You're welcome.
Okay, thank you. Let's keep moving along here. So I want to talk a little bit about the elephant in the room, the unfunded liability. I'll be talking about some actuarial stuff. Fortunately, Robin has already gone over the actuarial valuations and a lot about the information that's in those reports. So I'll kind of pick up where she left off. So when we calculate the required contribution for the pensions, we have two components. There's the normal cost piece, and that is the cost of the service that's being earned by the current employees. Okay, they're earning a year of service and increasing their benefit, and the normal cost is expressed as a percent of pay. The member contribution goes towards that, and then whatever is needed from the employer to make up the rest of that. And if you pay that all along, in a perfect world, that would fund the benefit at retirement. Then there's this other piece, which is the unfunded liability. You also pay a cost to amortize the unfunded liability. And the reason there's an unfunded liability is that over time, well, as we calculated the cost, the experience didn't come out exactly as assumed, or the assumptions that we used for the valuation about when people retire, how much they earn, those assumptions had to change, and an unfunded liability arose over time. So the employer also contributes towards that. The unfunded liability is simply the accrued liability of all the current and former employees of Yuba City minus the assets that are on hand today. So this represents additional cost to pay for the benefits that have already been earned. Agencies are required to make a minimum annual payment on the UAL, and as Robin explained, it's due in 12 monthly payments throughout the year, or you can pay it up front and save a half year's interest, and that's what Yuba City does. But that's just the required payment. You can think of the unfunded liability as long-term debt. It's an analogy. It's similar to a bond. Future payments are going to have to be made. And you could think of the discount rate as the interest that's being charged on that debt, as I've already explained why that is. Basic financial principles say that if you have a lot of debt and you want to pay it down, you should pay down the most costly debt first. And if you think of this discount rate as interest on your UAL, this could very well be your most expensive debt. The Government Finance Officers Association, GFOA, issued a best practice statement on pension funding, and they said that every employer that sponsors a defined benefit plan, like Yuba City, should have a formal funding policy. And this would provide assurance that benefits will be funded in an equitably and sustainably way. And I don't want to skip over those two words, equitably and sustainably. And what they're talking about is you don't want to set up an amortization period for your unfunded liability that has very low contributions now and very high contributions in the distant future, because it may not be sustainable. Usually an agency has revenue forecasts and budget projections going out 5 years or so, and you have this unfunded liability debt that's going out 20 to 30 years, and you don't have any assurance that those very high payments off in the future are going to be able to be paid out of city revenue. Equitably, what we're talking about is the simple idea in public administration, whether you're a city or any other government, that the services that are being provided to current taxpayers should be paid for by current taxpayers. Okay, and this unfunded liability debt is a compensation cost for current and former employees from the past. It should be paid for, before those people retire, ideally. So that's what we're talking about. Now, when managing this unfunded liability, we show you what it is each year, and we calculate a minimum required payment. But there are things that agencies do on top of those minimum payments to manage this unfunded liability. One of them is make an ad hoc additional discretionary payment. We call them ADPs. Yuba City did one last year, and Robin explained to you about how that $750,000 contribution saved money. You can do a fresh start, and you can set up an IRS Section 115 trust. Yuba City also has one of those set up. I'm not going to talk too much about those last two, but happy to answer your take questions on those. I'm more going to talk about the first one. How do these ad hoc contributions work? Why do cities make additional discretionary payments? Well, it saves money by reducing the future interest payments. It's money that you're going to have to pay eventually. Paying it sooner means it costs less. It can be done on an ad hoc basis, so you're not committed to doing it every year. And there's various saving strategies. You can I'll go into it a little bit more, but when you apply this to your amortization schedule to a short base, you get significant short-term savings, and when you apply it to a long base, you get more long-term savings. You can also use these ADPs to create stable contributions. So instead of being watching your contribution from CalPERS go up each year, you could set your own payment and make your payment based on your budgeted contributions. If it's done in conjunction with a funding policy, this is a way to handle your UAL pay down in a systematic way and provides that assurance that benefits are going to be funded equitably and sustainably. A lot of agencies do this. We have right now about 200 a year, about $500 million a year coming into the fund. That's in addition to the normal cost, in addition to the required annual UAL payment. And these are made and they save cities a lot of money. I listed some cities here. The city of Woodland made one last year. Lodi made one the last 2 years, and Rockland has made ADPs the last 4 years. And the reason I mentioned those 3 cities is I saw them earlier this year on your financial condition assessment that was posted that the city had done. And these cities are listed as cities that you are economically comparable to Yuba City. And I just said Yuba City also made an ADP, so this is something that the city's familiar with. And I know the city council has seen a number of presentations on this. So what happens in these? Let's go a little bit into the technical piece of it. So this is the amortization schedule for Yuba City miscellaneous plan. And each year we do evaluation. We have existing amortization layers from previous years that go forward a year with a payment and interest. And then we add new layers based on the experience that we've witnessed, any assumption changes that have happened, create new layers. And these layers are set to amortize over a very long period of time, so you get a large number of layers. This schedule is going to grow and grow each year. And so if you actually know where to look, you can actually see the Yuba City ADP on here. I'll help you out a little bit. So on this base, this assumption change from 2003 that had 5 years remaining, this payment that was made in 1819, this we show here over $1 million being paid. That was not the required payment. That includes the $750,000. If you look there, there was only a balance of 1.7 million. You still had 5 years left to pay it, and by bumping it up, that extra 750 reduced it drastically. And all the future payments, these 5 future payments, are now going to be lower than they would have been. And that's how the city saves the money. In this case, they save it over 5 years. This is the UAL balance. So we're starting here in 2018 at the valuation date. And it's 36 or 37, $38 million, whatever it was on the previous page. And we see this gray line of how it would have been amortized had you not made the ADP, and you see that first year it was actually increasing, and that's because the required payment was less than the 7% interest. But the city made more than the required payment. They made the extra $750,000, so they had that drop in the UAL, and the next 5 payments are lower than they otherwise would have been. Now, eventually, after that base is gone, these 2 lines overlap, and that's because after that base is gone, the benefit of the ADP is gone. And that base was chosen not because it's an assumption change, not because it was in 2003. We were simply looking at the years remaining and working with the city's staff to determine how the city best wanted to use that money, and they chose to put it on that 5-year base, which is fine. These are the payments. So the last slide was the UAL balance. Now we're looking at all those future payments, where the gray ones was before the ADP, boom, 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 and the orange one is after the ADP. It includes the ADP, right? So in 1819, you made a $750,000 extra payment, but these payments are a little bit lower, and then these are all the same. Overall, including the $750,000, the payments are lower from having made that advance payment because you're saving the interest over those 5 years. Okay, so, and we spend a lot of time with agencies kind of doing these kind of surgical strikes and where you want to use this money. You have all these bases, exactly where you want to apply it. But now I'm going to step back a little bit. So you do have all the bases, not just one. And you do have more plans than just that miscellaneous plan because you have the safety plans, the police and fire plans. If I lump them all together and look at the 2018 valuation results and project it forward to 2020 where we set the contribution, the UAL for all those plans is $80 million. And this is the way it's scheduled to be paid down over the years. And you can see some of this is owed to people who are already retired, and it's going to be paid by people who aren't born yet. At least some of it. And this is what the payments look like, and this is the issue you're dealing with, right? Is the steep increase in these payments over especially these first 3 years, but even then they keep increasing, and they go up to about $8.5 million. And what happens then is there's a base with 11 years left on some of these plans that gets paid off, and then finally you get some relief after 11 years. And that's what happens when you set up these very long bases. You set up a long base because you don't want to pay for an investment loss immediately. You want to stretch it out over time. Well, you stretch it out over time, it means you're paying for it for a long time. And you're paying for everything else that happens in the meantime while you're paying it off, right? So this is what the payments look like. Now, but that's not the only alternative. You can make additional payments. Now, I set up a mathematical example to demonstrate the math. It has nothing to do with what you are actually going to pay, but just how the math works. You see how the UAL payment, you were paying just a little bit more than interest, and eventually the UAL starts to come down. The payments were going up, remember, for 11 years. And eventually you get a little steeper decline in this UAL. It's a ways off, but it does come. You can instead decide, well, I like the idea of paying this off quickly. Let's make it go down steeper at first. Of course, that's going to mean higher payments. I don't want to spoil it for you. That's coming on the next slide. But this is the way, an alternative way to pay down the same UAL. And what does it take to do this? Well, this is what the payments would be. So the gray ones are the same one you already saw. You saw them ramping up very steeply for 3 years and continuing up. If instead you said, well, we're eventually going to have to figure out how to pay $8.5 million a year. What if we just started to do that right now? And I just picked the $8.5 million because that's where the peak was, not because I saw $8.5 million in your checking account or anything. So, and this is $8.5 million total. This is on top of what you're already required to pay, right? So it's $2 to $3 million more, and then even less out here. But anyway, so if you make $8.5 million for these 10 years, then the UAL would be much lower, and you could safely reduce your payments and continue to make progress on paying off the UAL. Now, the benefit of doing this that is hard to see in this picture is that if you decided, through some analysis and a few city council meetings, that you actually wanted to pay $8.5 million a year towards your UAL for the next few years, you could basically set that in stone, fix that in your budget. And that way, when you look at the valuation every year, you look at the investment gains and losses, chances are very, very likely that you would in fact be able to pay that $8.5 million. The required contribution is very unlikely to jump above that. And with each payment, with each year, you'd be reducing all these future required payments. So you would have to watch it every year because, things can change, but it's a way to fix in your budget and stabilize your contribution amount and say, this is what we're going to pay, this is what we're going to budget for, and you're not going to get any surprise from me or Ian in August when we release your valuation. So that's the basic idea I want to go over. ADPs, they allow you maximum flexibility. It doesn't lock you in to a higher payment schedule the way like doing a very short fresh start would do. Agencies can budget for payments. Now, the example I did was what if you want to pay the same amount every year? You might be comfortable with an increasing amount as long as it wasn't increasing as much as we see in the original schedule. You could have 2% increases every year. You could even have 2% decreases every year. Of course, you'd have to start higher if you wanted that. But you can decide yourself what your schedule is going to look like. Or you could say, well, we want to pay it off in 15 years. We're going to make ADPs every year and look at it every year and try and pay it off in 15 years. You could do that too. You can't do that by adjusting your amortization schedule because there's going to be new gains and losses each year that mess it up. If you establish your own funding policy, through city resolutions or whatnot, it provides assurance that the benefits will be funded equity and sustainably. I've said it so many times I can't even say it anymore. It handles UAL pay down in a systematic way. You're not subject to those market fluctuations where we say, ups, returns were bad this year, contributions go up. Up, they're good, they're going to go down again. You get to do it in a more stable way according to your own revenue projections. It allows you to budget these contributions in advance. I've already said that. And the actuarial experience is less likely to trigger a benefit increase. And the thing that we do show you numbers on is there's significant savings possible. In fact, I skipped over it so fast. It's usually the thing that we focus on. But if you look at this baseline projection, this $80 million unfunded liability is costing $150 million over this 30-year period. If you pay more now, it could be 129.6. So that's a significant savings. You could pay it tomorrow and it costs you $80 million, right? So you could save even more by paying it faster. But just something reasonable, paying it tomorrow is not reasonable. Paying it in some reasonable way according to your own budget, you can still get significant savings, and that's something to say. Let's not kid ourselves, right? If you wanted to contribute more, there's going to be some pain felt somewhere, right? Somebody wants to know that this pain is going to be worth it, and Kelly, and they want to see that there's some savings, some benefit from doing that, and you can point to these savings and see what that is.
As employees and wages increase, though, that line wouldn't be stable. Is that correct? That gray line would no longer be the line. If we have more people and we're paying them more, won't the contributions change? And the amount of money needed to fund that change?
Right. So there's so remember, we're not talking about the normal cost here. The normal cost, if your payroll goes up, yeah, you pay more normal cost. Those people are earning more service. If you give them more salary, it goes up, right? That normal cost is percent of pay. That goes up. That's not included on this chart. If you do things like give people much higher salary increases than expected, and the accrued liability goes up because of that, that's an actuarial loss. It's very similar to an investment loss. Yeah, that causes an increase in the unfunded liability, a new layer. So these gray bars would increase, right? So the gray bars are not fixed, and that's part of the problem. Here's what they're projected to look like now, and next year we have a different projection, and they're all different, right? And that is one benefit from picking your own contribution level higher than that. If they do go up a little, you're still covered.
May I ask a question?
Yes.
The one thing that I really understood, the statement you made, was that the children yet unborn will probably have to pay these debts. Is that correct?
Yes,
it might
that's right.
be the children of the children of the children that are yet unborn. That'll be paying the debts.
Well, we have it scheduled to be paid off in 28 years or so. So, 28 years from now, there's people in grade school whose children will be taxpayers. Then, yeah, I don't know if I go quite as many generations as you did.
Thank you.
Okay. Yeah.
So if the so if the unfunded liability is 80 million,
Yes.
and we're paying 7% on that, wouldn't it make a lot of sense for the city to go borrow $80 million at 3 or 4% and give that money to you and use the reduced contributions into your system to pay down the loan? Or even better, wouldn't it make sense to borrow 120 million and have it way overfunded? And in that case, we'd be paying 3% on investments that would be returning 6 or 7%.
It's tempting. So I will say, you're not the first person to think of that. So the city of Marysville, not far away, issued a pension obligation bond and paid $14 million to CalPERS, the city that's much smaller than Yuba City, right? Paid $14 million into CalPERS last month. Okay, so why did they do that? So, and is that a good idea? So there's a lot of risk along with that, right? We assume we're going to earn 7%. It doesn't mean we're going to earn it. Okay, but the interest that they're going to pay on their pension obligation bonds, that is fixed. They will have to pay that regardless of what happens to that money once it's in CalPERS.
What's the interest rate on those?
I don't know offhand. It's 3 something, I'm guessing, but it's less than 7 certainly, or they wouldn't have done it. But yeah, it's very risky. So you're taking a asset, you're issuing a fixed debt that you're on the hook for, and you're putting it into risky assets. So a lot can go wrong, and a lot has gone wrong. Other cities have done this. And with a market downturn, the biggest risk is that you have a market downturn immediately after you do it. It looks like a terrible idea for a very, very long time. So you have these projected savings, and I think you can look in the article to see what Marysville projected their savings to be. And that entire savings could be wiped out in a day, and then you still are paying that debt for 20 years with no savings.
So, excuse me, so the elephant in the room is what happens if we have a 24% loss like we did in 2008. The more you pay, the more you have in your assets, then the more you have to lose. And
Yes.
that's, timing is everything, right? And that's the risk.
Yes. So, right. So you can have a big downturn, but if you're thinking long term, in the long term, the fund's going to earn, it's not going to lose 24% every year, right? We don't know exactly what it's going to earn over the long term. It might be 7, it might be a little less, it might be a little low, but it'll earn something. So it's important to take a long-term view, and I guess that's what people do when they're issuing a pension obligation bond and putting the money in the pension. I will say that the GFOA that I've already mentioned, they have a best practice statement on pension obligation bonds, and they outline the risks in there. It's very easy to read. It's a very short paper. The risk is that you're putting more money in risky investments, but there's a number of other risks that go along with it. You're using up some of your debt capacity when you do that. It's money you can't borrow to improve infrastructure or anything else. But the GFOA, forget my own opinion, GFOA's recommendation is for public governments not to do pension obligation bonds at all.
If I may interject, several things that come to mind talking about doing the pension obligation bonds. The article that was in the paper talked about City of Marysville is doing it for cash flow purposes. As you said, short term that may work, but if we hit a recession, they could suddenly have another UAL because PERS not getting their 7%. Now they've got to make additional payments to get the new UAL that's laying out there. Plus they've got to pay their fixed pension debt obligation. And when you start getting all these going, now where you had a cash surplus, now you've gone to possibly a cash deficit. And then you try to borrow more money and your credit rating goes down and now money costs more. So you really get into what we consider a speculative market. And that's why you never want to try to twist this debt and wrap this debt and using kind of the technical terms to refinance it. Think of this much as we're all familiar with fixed mortgages on our home, and you can go pay additional principal and it can come down rather quickly. We all know that doesn't work so good if you're on an ARM because it's continually changing in the interest rate. It's the same thing that's happening here. You're throwing a balloon payment at something, but the rate of how that's going to affect is continually changing, so you don't know what the effect is. Plus, the additional balloon payment you're making, you could make $1 million payment, but because you're putting it subject to risk, it could only end up having a value of $500,000. So that's why you got to be real strategic and real careful. And I will say that our finance director has done an absolute wonderful job here we have a pension trust, so we have reserves setting there to help us absorb the increase. Because every time we have to pay PERS more, it takes away from the city services that we have to provide to our residents. And so Robin, you've been very diligent in this, and I commend you for this. And I don't say this just because you're getting ready to retire, but you have. We've met, and you know my feelings on this. You've done very well with this by not just lump summing it in, but holding back that trust fund to where if sales tax revenues go down, we can use those trust funds to make a current payment even, to still provide the services for the city. So it's the best option we have, and I totally agree. Pension bonds are probably one of the most riskiest things a municipality can do. If times are great, you're golden. But if it takes a turn, you can be in a world of hurt real fast. So.
That's right. So yeah, so Robin has done a marvelous job of educating you and the public and managing this debt. And what I've noticed is that as the finance director nears retirement, they are extremely good at making sure that the agency pays down the UAL. So I think that's what we've seen here.
We have people standing outside that are supposed to start their meeting in 5 minutes.
Yeah, I think I've covered everything, and that. So I'm going
And I would just like to say thank you very much for coming. Mr. Schneider helped me with looking at the city's options for trying to address our UAL. I became very concerned because we were barely covering the interest on our UAL payment, and I wanted to see us at least start whittling it away. So that's why last September I approached City Council and asked them to consider an additional discretionary payment. Mr. Schneider and I went back and forth via email, off and on over a period of about 9 months. He always made himself available and answered my questions, and I asked a lot of questions. So thank you very much to all of you for joining us tonight, and thank you so much, Mr. Schneider, for all your help.
Thank you for having us.
I thank you guys as well. I really appreciate you coming up here, spending your evening with us. I think it was very informative. We really appreciate it. Thank you. We have a couple things for it. We have 2 here and 2 there for 4 of you, so 1 second.
While they're giving those gift bags to our guests tonight, I want to go ahead and set you guys up for our meeting next month. Next month, I will be leading the discussion, and it's about what our options are to go forward. The next 2 meetings is about coming up with ideas and then solidifying a plan in December. So next meeting, think about all the information that we've digested, what our possibilities are, and I really want this to be a group effort and to see, what we can come up with. I do appreciate the gentleman tonight and the gentleman at our last meeting. It's been a lot of great information. Lloyd, thank you for the article. I appreciate that. It came through Elaine. And Mr. Mayor, do you have anything else? Where'd he go? Good. All right. You guys have a wonderful evening. We will see you at next month's meeting to try to wrap this thing up.